No deposit, no problem. In this video, we're going to look at how it's been made easier to gain a 100% mortgage, so a mortgage with no deposit. My name's Aaron, I'm one of the directors at Create Finance, so let's get into the video. So why has it been made easier to get a mortgage with no deposit? So recently there's been a new scheme that's been launched by a lender which helps people with no deposits. So since 2008, we've not been able to get a mortgage with no deposit until now. So if you haven't been lucky enough to build a savings or be able to obtain a gift from a friend or family, this is a great scheme which is available to you. The scheme itself is called Track Record Mortgage. So this scheme is currently available for first-time buyers who are also currently renting. And what the scheme looks at is in the last 18 months, have you met affordability on both your rent and your household income, and you can demonstrate that for a period of 12 months. The monthly mortgage payment must be equal to or lower than an average of your last 6 months worth of rent. Therefore, let's say for example you are paying £1,000 per month in rent and you have been doing that for the last 12 months. What the lender will do is they will look at the affordability of the mortgage based on a figure of a mortgage payment of either £1,000 or lower. For this scheme, your credit score does need to be strong, with very few or no credit blips in the background. So if you are unsure about your credit score, then there's a great website called Check My File, and what that will do is it will look across 3 different credit reference agencies that lenders use when assessing mortgage applications. Okay, so the next scheme that's available for people that are looking for 100% mortgages is something called a family assist mortgage. So instead of using your own deposit, maybe a parent or a grandparent uses their own funds or security to help you achieve a 100% mortgage. So depending on the lender that you approach, the lender may ask for up to 20% worth of security. And as mentioned earlier, that can be in the forms of either savings. So if your parents or your grandparents may have some savings at the background that they want to help towards the family assist mortgage, then they can use that as part of the deposit. The other way is by using the security within their own home. So maybe they have a house that doesn't have a mortgage in the background, or they may even have a mortgage but have lots of equity available. What they can then do is they can use that equity to help towards the deposit. So the deposit that's then used for the purchase of the property is then held by the lender for a certain period of time, typically up to 7 years. And again, that does depend on which lender that you approach. Then after the 7 years, as long as then you've met certain requirements with that lender, such as maintaining your mortgage payment, the funds are then released back to your family member. So the hope is once you get to the end of that 7-year period, you are then able to take on the mortgage because you've built up enough equity within the property to move yourself onto a conventional mortgage. It's also really important to know that the property is owned by the person that's buying the property, so the family member doesn't hold a charge on that property. Now with this type of scheme, because there's a physical deposit that's being changed hands, the lenders can take a more common sense approach to adverse credit. So if you have had credit blips in the background, maybe a default or a CCJ, or maybe it's some late payments, the lender will take a more common sense approach when it comes to this type of borrowing. So what we define as a common sense approach is it may be that the adverse credit was experienced while you was not working, and it may have been 3 or 4 years ago. So let's say, for example, you were to obtain a default during a period where you was unemployed. As long as you can provide information to the lender, then that will make them more comfortable in terms of the borrowing. The family member providing the deposit is also advised to take independent legal advice, and that's so that they fully understand the commitment that they are entering into. So the other option with family members providing a deposit is also a gifted deposit. So rather than before the family member wanting their money back, a gift is where they gift you the monies. Now for that type of mortgage, you may only need up to 5% as a deposit. So that can make things more achievable when receiving a gift from a family member. Again, if you have experienced adverse credit, the deposit that you might need for a gifted deposit mortgage may be higher, dependent on when that adverse credit took place. So the next area that we can look at when it comes to mortgages with no deposit is shared ownership. So shared ownership is a government scheme, and essentially what it does, it allows people that are first-time buyers or people that don't currently own their own home an opportunity to purchase a share within either a new build or a resale property. And the way the shared ownership scheme works is the buyer essentially purchases a share within that property. And that can range from anything typically as low as 10% right the way up to 75%. So let's say, for example, you was to purchase a property for $300,000 on the shared ownership scheme and you was buying 50% share of that property, then essentially you will be buying a £150,000 property. Now that can make things a lot more achievable when you're looking to get a mortgage, especially if you're on a lower level of income. For the remaining share that you don't buy, you then pay rent on that share. So again, as an example, if you was buying a £150,000 share and there was £150,000 that was still owned by the housing association, they will charge you rent comparable to that £150,000. So with this government scheme, there are certain requirements that you have to meet when it comes to shared ownership, and the main one is around household income. So the maximum income that can be coming into the house for the shared ownership is £80,000. And if you're in London, that is also increased to £90,000. Your income multiple does also form part of the affordability assessment when it comes to the shared ownership scheme. And the maximum amount is 4.49 times. When it comes to adverse credit with the shared ownership scheme, again, there are potentially lenders that are available to you if you have had credit blips in the background. So again, if you have experienced defaults or CCJs, then it's certainly something that you can look at with the shared ownership scheme. And the final part to the shared ownership scheme is something called staircasing. Now what staircasing is where you buy further shares within the property. So let's go back to the example at the beginning where we said that if you bought 50% share of a property, which then meant that you owned £150,000 of that house. It may be that in 2 years' time you are in a better position financially and you want to buy a further percentage share in the property. So let's say, for example, you were to purchase a further 25% of the property, taking you up to 75%. That is something that you can do as long as affordability allows within the shared ownership scheme. And therefore you can staircase right the way up to 100% of the property. And that ultimately is your goal. So just as a reminder, the first scheme is called the track record mortgage, although at the moment there is only one lender that will allow you to use that scheme. The second part is the family assist mortgage. Again, there are lots more lenders available for you to use that type of scheme. And then the third one is through the shared ownership scheme. So to make sure that you choose the most appropriate scheme, meaning that you get the right interest rate and right advice, make sure you reach out to a mortgage broker. So if you feel that the shared ownership scheme is the best option for you, check out this video.